Hello, all of you. So today we are going to discuss about the one of the topic of CPA FAR subject, which is about the inventory. So we'll see if, and talk through a few concepts of inventory. So to start with, you have to log into mycpa.club, and then from here you can reach out to the FAR section where you have inventory as a topic. So let us see what are all things that we are going to study in this topic of inventory. Uh, Yeah, so this is a quick layout what we are going to study. One first part is about what is all included in inventory. So inventory is a purchase price or a consideration uh, from the inventory valuation standpoint is a purchase price or a consideration which is paid to bring that inventory to that specific condition. So in this there are various classifications like raw material, finished goods, work in progress, retail inventory. So we are going to study those things. And what all things are included in the cost of inventory? So it is purchase price, freight, purchase discount is deducted, and if there is a normal spoilage, then that is also adjusted. So that's how we get the direct material cost, which is being incurred to bring inventory or to create that inventory. If it is, say, work in progress inventory or finished goods inventory. Apart from that, uh, companies do also incur direct labor and the manufacturing overheads. So that's about uh, the overall valuation of inventory, what are the components, and how the costing happens. So there are two main systems of maintaining inventory, and that is the periodic method and the perpetual method. So we'll talk through more about it. After that, we'll understand the how the cost of goods sold uh, is derived, uh, which is then goes to our income statements. Then there are certain concepts of the shipping terms. There are concept of consignment sale. Then there are various, say, inventory uh, costing techniques. It can be at cost, at market price, at replacement cost, at net realizable value, average cost method, how it changes in the perpetual system and how it changes with the periodic system. So there are various inventory costing method, which includes specific identification method, average cost method, FIFO, LIFO. Uh, so these are all basics, fundamentals about the inventory that we are going to study. Uh, so let's go to our main notes here. Yeah. So the topic of inventory is in as per US GAAP is covered in Accounting Standard Codification 330. Um, so first part deals with the type of inventory. So inventory can be retail inventory, which is held for sale. If it is a trading business, which can also be called as a merchandising inventory. Uh, in case of manufacturing companies, you have raw material, work in progress, and finished goods. Then all these goods and material are to be included as a part of inventory. When we call something as inventory, it includes all these goods and material, which is retail, uh, inventory, raw material, work in progress, and finished goods. Then there are two systems of maintaining inventory, which is periodic and perpetual. Again, we are going through the summary of like the inventory cost assumptions, cost to assumptions are there, wherein the first one is specific identification method, FIFO, weighted average, moving average, LIFO, dollar value. Then there is a method of gross profit, and there is a concept of firm purchase commitment. So these are all concepts that we are going to talk about. So talking about inventory, like what is included in inventory. So goods and material to be included in inventory includes goods in transit, FOB shipping points, and the FOB destination. So there are two types of, there is a concept of goods in transit. Say if goods are being purchased and they have not yet reached our warehouse or warehouse of company. So whether that has to be included as a part of inventory. So it depends on this condition whether the procurement is happening on FOB shipping point or FOB destination. So if it is happening at a FOB shipping point, then obviously goods in transit are part of our inventory because we run with the risk of holding that inventory. So the ownership of inventory is being transferred at the shipping point. FOB means free on board. And if it is FOB on destination, then obviously that part of inventory will not be included if it is goods in transit. So shipment of non-conforming goods. So if there are certain non-conforming goods, they are not part of the buyer's inventory. Say if buyer has bought some inventory and then if that uh, inventory is subject to testing or quality testing process, and in case if that is rejected, then even if the position of inventory is with the buyer, but that won't be part of buyer's inventory. Then consigned goods are again inventory of consigner, not of a consignee. Then in case of public warehouse, part of inventory of a company holding the warehouse receipt. So whoever is holding the warehouse receipt is the owner of the inventory. If it is a public warehouse where the company has uh, rented some space and they are keeping their inventory there. Then sales with mandatory buyback. So goods are seller's inventory if it has got a mandatory buyback condition. In case of installment sale, it is buyer's inventory because obviously uh, buyer has got position and full control on the inventory. It is just a financial arrangement where buyer will pay on installment. So that doesn't change anything with reference to the ownership of inventory. So that's why in case of installment sale, the ownership of goods is with the buyer of the inventory. Now we'll see about what all things are included in case of valuation of inventory. So valuation of inventory includes all cost associated with inventory until the point of sale. So what is included is direct material, direct labor, direct and indirect overheads, both fixed and variable. Then freight, insurance, warehousing incurred up to point of sale. So you have to know that freight, insurance, and warehousing, this can be included as a part of valuation of inventory, but up to point of sale only. So handling cost, recapping, packaging, then normal spoilage, etc. Is also added, and then the purchase discount is adjusted. So, what is not included in the valuation of inventory? So, unallocable fixed overheads. So, fixed overheads which are not allocable specifically to the manufacturing process are not part of the inventory valuation. Freight out and sales commission. So, commission which is given to an agent to sell the goods is not the uh, part of valuation of inventory. In fact, it is the SG&A cost. Freight inward is part of inventory valuation, but not the freight outward. Uh, from the point of sale. Then abnormal cost of excess spoilage is not part of inventory valuation. Purchase discount lost is not part of inventory valuation. You cannot say that, okay, means if I would have paid early, then I would have received the discount. But since I have paid late, I have lost the discount. So all those subjective things are not part of inventory valuations. And interest and financing cost is part of the financial cost and not part of the inventory valuation. So as per US GAAP, inventory is valued at cost, and cost is equal to price paid or the consideration given to invent acquire that inventory. So that is all included in cost. So coming to inventory valuation definitions. So first we should understand few definitions. So first is the market value. So what is called as market value? It is median of a replacement cost So there are three types of concepts. One we have is a replacement cost, then we have market ceiling, and then we have market floor. So median or middle value of all these three is a market value. Replacement costs, cost to purchase on valuation date. So if you have to buy similar inventory on the date of valuation, so what is going to be the cost? That is a replacement cost. Market ceiling. So market ceiling is nothing but the net selling price minus cost to complete the disposal. Uh, so the net, it can also be considered as a net realizable value, because there is, if there is some cost has to be incurred to dispose of the inventory, then that cost has to be deducted from the net selling price, and what we get the market ceiling. What is market flow? So market ceiling minus normal profit margin is market flow. So these are four words which you all should know these concepts. And based on the replacement cost, market ceiling, and market flow, the median of that is the market value. So there are questions which are being asked in CPA exam, which where you need to apply these concepts. So understand these concepts properly and remember those. Obviously, they are not very hard. So inventory value and method of valuation. If inventory method is LIFO or retail, then lower of cost or market value. So if a company is following LIFO or retail inventory method, then they should use lower of cost or market value, and otherwise they should use lower of cost or NRV. And we have seen what is the difference between NRV and market value in the above definitions. So departure from cost basis. So which are the cases where the cost basis concept is not used, or this assumption of cost basis is not used. So first is in case of precious method and farm product, the cost concept is not used. In that case, it is NRV. Second is in case of ordinary course of market utilities of goods. Market utility of good is no longer greater than the cost. Then the lower of cost or market and cost or NRV. Inventory is valued at below cost in period in which loss occurs. So if it happens that you have a product which has become obsolete, and uh, overall from the market sentiment standpoint, uh, in ordinary course of market utility of that good has is no longer than the cost, then obviously people will not buy that for a market price. So in that case, this inventory is valued at cost, lower of cost or market price, or lower of cost or NRV. So this is one of the exception. Then recognize loss in current period in COGS if material, and then identify separately income statement. So in these cases, loss has to be uh, recognized in current period, and it has to be grouped into COGS, cost of goods sold. Reversal of inventory write down is prohibited. So in as per US GAAP, once the inventory is write down, we cannot write it up. So it's that is prohibited. So these were the key concepts about the inventory. So there are a few more concepts which we'll see in the next session. Till then, uh, keep learning and keep practicing. Thank you.